to turn it on. No, I turned it on yesterday. Oh, turn it off? No, I turned it off too.
Thank you.
No problem.
Sorry about that.
No, that's no problem. Hello, everyone. Thank you for joining us. We are just a tiny bit behind. So while Gordon is putting on his lavalier microphone, I am just working over some of this stuff really quick, and then we can go ahead and get started. There's my mouse. All right, cool. Bringing up Vantage Point, bringing up PowerPoint. Hey, that's 2 points. Vantage Point, PowerPoint, that's pretty awesome. Let's see, actually, we'll take this and put it over here. And then start the presentation, we'll just throw it over to that screen and we'll be good to go, right? Sounds good to me. All right. Sorry for the delay, everybody. Welcome to the Trader Continuum live broadcast for the day. This is Wes Walton and Gordon Scott, CMT. And today we will be talking about several different things. I sent out a little bit of a tentative agenda for this particular broadcast. We'll be talking about divergence. We'll also be talking about the step-by-step program for the Trader Continuum, the way that the curriculum is set up and the way that the program is structured and all that cool stuff. And we will also be talking about building indicators with a specific purpose in mind. So this particular time, I think we're going to start with the step-by-step program, if that's okay with you. And then after that, we'll get into some divergence stuff. We'll talk about some indicators and how to build some indicators with a specific purpose in mind. And this is going to be a lot more interesting than when I just sit here and talk about it myself, because we have Gordon here who's going to be able to offer some pretty unique insight into what indicators are used for and why we use them and how we use it, etc. So we'll get into that in a little bit, but for right now, let's go ahead and jump right into the step-by-step program. So let's see, we want to pull up, let's see, we want this over there. There we go.
So while Wes is getting the slides in place, let me just preface this presentation by letting you know that what we want to do with step-by-step is create a framework for the things that you learn as part of the Trader Continuum. And so what are we looking at here? We're looking at the screen?
Yep.
Or we're looking at,
you can
okay,
see, right? That's the program, so
Got
we're
it.
looking at that.
So the idea here is that I'm going to go through this presentation, and everybody who's watching it for free, lucky you. This will be behind our subscription-only paywall after a few weeks or less, depending on what we do. But we're basically going to go through the Trader Continuum curriculum between now and the next couple of weeks, a day at a time. And so, again, lucky you if you're here now. But for those that come in later, the presentation will begin here. The Trader Continuum has a place for you if you recognize that you need to improve yourself as a trader. Well, anybody who's going to actually last in the business of trading should recognize that. So how do you go about doing it? They say, it takes 10,000 hours to get good at anything. But actually, Malcolm Gladwell's use of the
10,000 hour rule.
Yeah. I think it was a Danish guy who did the.
Oh, yeah.
His popularization of the study that was done was really not about getting good at something. That was about becoming world class. And just that a lot of people who became world class took about that much time to hone their craft to the level that they could compete on the world stage. As a trader, you don't need to do that. You don't need to become world class. Well, if you want to manage millions and potentially billions of dollars, then yeah, you do. But to get to the point where you can say, this is worth my time to do, and I actually want to do more of it, and I like doing it, and I can do it competently. I have the confidence that I can be competent at trading. To get to that point, it actually only takes roughly 1,000 hours, give or take a couple hundred. If you've been working at it quite a while, it's going to be that is to say, less than 1,000 hours. And 1,000 hours, if you were working full-time, 8 to 5 on something, 1,000 hours is about 6 months of 5 days a week. So I found for myself, I should say, that it took me about 4 months when I was getting started to get to the point where I felt like, okay, I think I know what I'm doing now. I mean, I'm not sure, but I'm going to keep trying out what I think I know I'm doing. And then the next 2 months solidified that. And so after about 1,000 hours of working at it, I had gotten to the point where I realized I could trade. I could trade, and I was going to hope to make millions, but that wasn't necessarily my thought or my immediate plan. My plan was, this is worth my time, and I'm going to learn and learn and learn and see what the best way to go forward is from here. And I've chosen my path that way ever since. In fact, I have chosen jobs that I have had over the past 15 years, specifically based on the idea of whether or not they actually allow me to trade as part of my job, because trading has come first ever since that decision. And so I just tell you that. I'd like to tell you more about my story at some other point. I started out with IBM. I worked for IBM for 10 years. And then right around the time of 9/11, I found myself having to make a major career change from technology that I was in into something else, and I chose the stock market. So that's kind of a weird choice, but that's what I chose. And for the next 2 years, I spent a lot of the time adding to what I already knew. I knew some stuff about it. I'd actually done well in my 401k working for IBM, but I added to my knowledge in a very distinct and serious way to the point where I could get into a position where I could help others. I recognized early on that my value was going to be helping other people seriously improve at trading, as opposed to being the next Stephen Cohen. That wasn't going to be me. But I have, I'm quite happy to say, learned how to trade well and had success at teaching others to do the same. So over the years, I've refined the methods that I use to help people understand, and realize that, coming from a variety of different places, how you're going to get there. Well, this framework is what we have in mind to help you understand. So step-by-step method looks like this. STEP is a little bit of an acronym. I've been talking over the top of these bullets for a little while, but it's simple. We want to seek and learn strategies, and your intent in seeking and learning strategies is to find ones that fit you. You want to try out those strategies, test them, and you want to make them work for you. You want to engage them with your money, assuming that you've tried them out and feel comfortable giving that attempt. But your intent in engaging them with your money is not to just flat out make a bunch of money. The first thing you have to do is prove that these strategies are worth your time. So there are a lot of good strategies, a lot of them that work, but do they really work within the time frame that you have? And do they work well enough for you to feel comfortable committing to them? Then last of all, once you've gotten to a point where you understand the strategy and you can actually work with it, then the next thing to do is to promote the strategy to an algorithm. And that is either following a set of rules or actually automating them.
Oh, you want to come back to the...
Yeah, do we have that highlighter shadow thing?
So, we do.
Or just a way to, kind of guide people through this. Yeah.
Yeah, it's right there. Sweet. There you go.
Okay.
Just press and hold the top button.
All right, so we're going to go forward then. Just one click takes us to the next slide. Is that right?
That's if we have this up here. Okay, so one click should take you forward.
There we go. All right.
Yeah, there we go.
So this is the step cycle. We're going to first, as we mentioned, seek and learn the strategies, and our intent is to find what works for us. And then we're going to test and try the strategies. Our intent is to work through that, finding out whether or not they work for us. See, it's such a big deal because, Tom Basso, he was a legendary trader, interviewed in Market Wizards and so forth. He was famous for saying, I learned all about trading, and then I learned about mechanics and risk management, and then I learned about psychology. If I had it all to do over again, I would do it the other way around. And it's taken me years to understand why he said that, but I do now. I understand why he said that, because so much of what you do has to do with your decisions, your traders. In other words, you sort through, you choose this, you choose that. And the question is, are you really spending your your time in the right place? Finding something that works for you is the critical piece. And then once you have found it, actually proving that it works out. You engage and evaluate the strategies, and you're trying to prove that in fact this strategy is worth your time. Your time is immensely valuable, so much more valuable than you realize. I mean, a simple thought goes like this. If you expect to exist 300 years from now, what are you going to do between now and then to make the best use of your time? Sitting poolside and counting towels on the deck, or jet streams that fly over, isn't really going to build. Everything we do, every little bit of knowledge that we gather and possess, builds on itself, or at least has the potential to. And we can think of it as an interest-bearing item. An idea, a behavior, an activity gains interest based on how valuable it is. So if we bring it into our lives and it pays us interest over time, then in 300 years, think about 10,000 years from now, right? Now, if you say, well, Gordon, I don't believe in any of that. I believe that we go in the ground and we're worm food and that's it. That's fine. That's fine. But okay, so you got 70 years in your life at least, and maybe that's 10, maybe that's 20, maybe that's 30, maybe that's 40 from where you are now. Doesn't matter. Any amount of time will be benefited by what you start with and the kind of things you learn. If you like learning the markets, I happen to think that the markets are one of those valuable things you could study because it helps you deal with uncertainty. Dealing with uncertainty is a transferable set of knowledge to every other facet of your life. And so anyway, the engage and evaluate a strategy, prove it is really worth your time, and see that's not the same for each person, right? Everybody has different. Well, my time is worth this. My time, I only have this much of it, right? Anyway, so we move on to the last bit. We program and we promote. And when we say program, we don't necessarily mean writing code. And we promote it into this state of automation. We want to make it so that it's automatic, and that's whether a computer's running it or whether we are just doing it and we're fine with going through it because we like going through those. You know, you get up in the morning and you eat something for breakfast that you like. Why do you do that? Because you like it. Yeah, you're hungry. But why do you choose that particular thing? There's availability, there's all this other stuff, but given all other choices, you end up choosing what you like. So, and you repeat that. You repeat that over and over again based on what you like. So that's what you do, is you automate what you like to do, and it's a regular set of activities. And now if you don't like actually doing the activities, but you believe this is a good strategy, that's a strategy you really should figure out a way to turn into a computer code and have a computer run the strategy for you so that you can go sit poolside. I'm just, okay, little joke there, right? Now, the last piece of this, so that's a nice framework, that's all a bunch of platitudes, but how does that really tell you what to do? Okay, that's where I want to try, if I can, and get to this point. Let's see if I can bring up a writing tool here. All right. So there are three parts of the spectrum in this particular topic of allocation. We're going to call this conservative, as marked by 1 line. And we're going to call this aggressive, as marked by 3 lines, and then this as somewhere in between. And when we say conservative or aggressive, what we're talking about really has to do with the amount of concentration of effort into a strategy, or diversification. So when you are most concentrated, this is trader behavior. This is trader world. When you are more diversified, this is more investor behavior. And then somewhere in between is just the combination of things. So what we really want to try to figure out then is, I'm going to stick with the highlighter, see if I can still get to work, is where we fit here. And this has to do mainly with how much time you want to spend. So I'm going to write a big old T here, and then I'm going to write a little t over here. That's supposed to be a lowercase t. All right, yeah. So the idea is on this allocation spectrum, you also have the variable of time. And the more time you're willing to put in, the more concentrated your strategies can be. The less time you want to put in, the more diversified your strategies should be. So I'm going to write some numbers here if I can. This is, please forgive my horrible mouse writing here. So this is 2, 2, and we're going to go 1, 1, 1, 1, and then 5. Oops, that didn't work. 5. That's actually like 0.5, okay? 0.5, 0.5, there's a better one, and 0.5 for the final one. So the idea here is these are percentages. 20, 20, 10, 10, 10, 10, 5, 5, 5, 5. So multiply all these by 10. Those are your percentages. This is the idea that you, at a fully diversified portfolio-based strategy, you are going to have 20% of your money in one thing, 20% of your money in something else, 10% in 4 different things, and 5% in 4 more different things. Now, you don't really want to get, this sets up the idea that you're going to have 10 positions in a portfolio. If you say, well, Gordon, I got a lot of money. I got $1 million. I want to have my money spread out over, like 40 or 50 different stocks, or maybe you're actually in the process of actually managing somebody else's money, and you have, multi-millions under management, and you feel like, man, I got to have a whole bunch of different positions. That's definitely the kind of thinking that large institutional fund managers have. The problem there is that once you get past 18, there have been studies done on this. Once you get past 18 positions, you're losing the benefit of diversification. At that point, you're spending a lot of time and you're wasting it, because you can get the same kind of performance, you can expect the same kind of performance just grabbing an index. So my expectation is if you want to have a lot of positions, then take these 20s and pick your index that you like. And just know that index is going to have a whole bunch of positions inside of it, and it's going to measure it for you or do it for you. Pick an ETF or a mutual fund, and then just go there. Now this allocation format is best going to be done by rebalancing. I'm going to just write REB in here. Rebalancing. And so it's a question of how much time you want to spend. Do you want to spend just a little bit of time each month? You don't even want to spend it once a month. You want to spend it once a quarter, or maybe you want to spend yearly. Great, fine. Whatever it is, make that your rebalancing, and then just set your allocation and then rebalance it periodically, however often you want to come at it. What kind of strategies will you have? Well, what you do is you look over, hey, what kind of strategies, what kind of expected outcome will this strategy give me? And then you populate these slots with each one of those strategies. Now, you can think of an individual stock as a strategy. Okay, think about that. Think about Apple. Apple has $238, I think, billion in offshore cash reserves, which they're actually going to bring back to the United States, some of it because of the Trump tax thing. So what are they going to do with that? Well, that's just the stuff they had extra. They've already got lots and lots of money that they've been putting to work in various ways, and they've concluded that some of that money ought to go into making iPhones, some of that money ought to go into making iPads, some of that money ought to go into buying back Apple shares of stock. Some of that money ought to go into paying dividends to the shareholders so that they can get lower tax rates for at least some of their income. Dividend income gives you lower tax rates because it's taxed at long-term capital gains. But if you're a high net worth individual and you're getting taxed 28, 30, 35%, you're going to get half your taxes cut for all your dividend paying amounts. That's why Bill Gates paid himself like a $90 million dividend one year. I mean, it was a distribution to all Microsoft owners, and it took the stock down $3 a share. But because if you calculate the amount of money that he got from that, it was something like $900 million, and so he saved himself like $90 million in taxes by issuing that Microsoft dividend. So anyway,
only $90 million.
Yeah. Pittance for his summer home. So anyway, so your allocation on the low end, if you don't want to take a lot of time, then you do want to have a lot of diversification, and you should think of each stock or each index as its own strategy, and just think, well, what does this strategy return? Apple, that's a pretty good strategy, just buying and holding Apple. I got a funny story about a waiter in New York who bought Apple over the years, and some of it was as little as $1 per share way back when. Held on to it forever. He's this waiter. He's making about 150 to 100,000 a year. 50 when he's early in his career, 100 when he's later. But he made over $17 million holding Apple. And I asked him, how on earth did you hold that long? How did you hold Apple? So because Apple's gone up and down, and so it's almost as bad as Bitcoin, right? Not quite, but 75%, multiple 75% drawdowns in holding Apple. How did you manage to hold all those years? It's like, well, after I got a divorce, then the Apple shares got put into a trust fund, which both my mother-in-law and myself had to sign off on in order for us to take anything out of, and we could never agree. So we ended up holding it all those years. Like, that's a pretty extreme strategy to make sure you hold on to a position, is to have your mother-in-law have to sign off. But most people don't have such an ironclad strategy. So you've got to factor in to whatever, if you're picking an individual stock or an index, where you got to factor in what a likely drawdown is going to be, and what are going to be your rules for, okay, that's enough of that strategy, we're moving on to something else, right? So that's the thought. Well, out here on the other side, though, we're going to look at something more like 3 strategies, 3, maybe more, but of course more is moving to the middle. So your 3 strategies are going to look like this. You're just going to go 4 and 4 and 2, and you can change that around to 5, 3 and 2, 6, 3 and 1, actually 6, 3 and 1 is probably your best strategy once you get really good at your best strategic mix. That's once you find a strategy you are particularly really good at, then that should be 60% of your effort, time, and money, and then 30 and 10 for these other ones. And then you move strategies in and out as you get good. But the fact is, if you got a strategy and you're good as a trader, then it's like Apple. Apple's trying to figure out where they can put their stock that will return the best. And as far as they're concerned, buying their own shares is a really good idea, right? They believe in themselves because they understand it, they have control over that. Your best strategy as a trader is something you believe in and you have control over, so it makes total sense that you should allocate the largest amount to that. So full concentration, you're just looking at 3 different strategies, that's all you need. And everything else in between, is going to be anywhere from 4 to say 7 strategies, and I think really more like 4 to 6 is a really good idea. Now, the wonderful thing about what we've done with the Trader Continuum is that we've picked up a group of experts, 5 experts in addition to Wes and I, and none of us trade the same way, but we're all proven excellent traders, and we have strategies that we can teach you. So all of us have not only learned how to trade well, but we are adept at teaching. And maybe you could find better teachers on the planet. Maybe you could find a combination of a better teacher and a trainer somewhere on the planet. Great, go find them. We like to think that we have an interesting group, not only because we're good teachers and traders, but because we are sufficiently diversified. Each one of the trading strategies that are going to be offered instruction on through the Trader Continuum is so different from each other that you can consider them uncorrelated income streams. And that gives you the ability to pick and choose and put them into your allocation in a way that makes sense. So if we were to be looking at the fully concentrated strategy, imagine, for example, that you get working on this and you decide, you know, I am really into Doug's option income strategy. And I'm just going to work that until I get really good at it. And so that's going to be 40% of my capital. And then I really like Wes's robots. I really like the idea of I can automate something and just go with it. So I'm going to put 40% of my capital into FX automation. Or maybe you get, you know, better at one than the other, and you say, you know, 6 and 3 or whatever. While you're starting this, what I recommend you try to find a 4, 4, and 2. And then last of all, you can say, well, Gordon's whole bit about his 56-week pattern makes so much sense to me. I'm just going to try to find the 20 stocks that rule the world and play the 56-week pattern with 20% of my money. And that is what I'm going to work on as a trading strategy. Now, maybe you find trading strategies outside of the Trader Continuum. That's fine. We are going to also show you how to evaluate what a strategy's expected outcome is, and over time, what its expected fluctuation and drawdown might be, so that you can kind of know, what am I getting into with having 3 or 4 strategies? The worst thing in the world would be to have 3 strategies that all essentially do the same thing. As an example, imagine you bought Amazon, Facebook, and Netflix, right? 3 of the FAANG stocks, right? They have the same investors. They have very similar goals. They don't have exactly all the same product sets. Amazon's got everything, you know, and Netflix is very concentrated. But Amazon Prime, Netflix, Facebook, advertising, social media, so forth. It's just, there are a lot of the same investors, a lot of the same trends, a lot of the same outcome. They're all 3 part of the NASDAQ 100. They are so very correlated to each other that if conditions are good for one of them, chances are they're good for all the same. So if you just put all 3 of your money, 4, 4, and 2, in those 3 stocks, thinking of them as strategies, right? Then what's going to happen? Market goes bad, they're all going to go down. That's like what happened in 2008. The S&P 500 dropped 50%. And everything in the S&P 500 went down on average that way. In that case, you want to have a diversified strategy. You want to be at least able to say, okay, well, I'm going to hold on to the S&P, but I'm also going to be looking at some kind of Forex. And at that time, if you're a Forex trader, you could recognize going short the euro or long the dollar would have been this wonderful thing. So stocks are going down, but the dollar is just flying high, and you're making money at that. So you know, you're equalized and balanced. And outside of that, there's all sorts of other you know, investing possibilities, right? They're penny stocks. Done right, penny stocks are an asset class all to themselves. Intraday futures trading, which you're going to learn from Chad. This is really wonderful because, you know, options, directional options. A lot of people think, oh, I wish I knew 2008 was coming. I would have just bought a put option and had it drive all the way down. Yeah, you know, what's really interesting is that as huge as that drop was, and it was huge, almost every scenario you talk about where you could reasonably have held on and recognized the need to do so, you only end up with about 4 times the amount that you risked or that you allocated to that options trade. It's fascinating. It has to do with the fact that premiums got really heavy and the spreads got really wide at the bottom of 2008, and so it made taking a profit hard. And the intraday stuff down there on options, forget it. But you know what did work, and what gave you lots of multiples of return, is intraday futures. And so learning a strategy like intraday futures in that wild and woolly market is fabulous because you can pull out that volatility as long as you know how to manage your risk. Then you can pull out that volatility regardless of what the market's doing, up, down, sideways, whatever. And and then Forex is similar, but I mean, think about what happened in the case of the Forex markets in the aftermath. After 2008, 2009, 10, 11, that's when the Forex markets were going all over the place, and there were a lot of big opportunities. Again, you have to manage your risk, but there's some really big moves for short-term traders there. So we have this collection of people that have both asset class differentiation and knowledge differentiation Giorgio is going to be helping us with the volatility and the market sentiment to understand the things that Giorgio is going to teach you are going to help you recognize when it's time to sort of overweight one strategy over another or shift your allocations and so forth. So all of this framework of STEP really comes down to being put to use in this notion of how am I going to allocate money to strategies? Now you might say, look, I want one strategy and I'm just going to allocate 100% of my money to it. I'm going to be an intraday trader and I'm just going to grab 10 cents a day on NASDAQ stocks and 3,000 shares, 10 cents a day, $300 a day, and I'm done. That's my whole trading life. That's all I want to do. Great, that's fine. You live at $6,000 a month. Good for you. Hope you enjoy Costa Rica or the Philippines or wherever else. You live like a king in those places, right? So the thing is, if that's what you want to do, you will come across a problem. You may not come across it for years, but you will come across a problem. I sat in a proprietary day trading office and was just shocked at how those guys, they had that mentality. They're like, I don't care what's going on with the best market. It's just what's happening between the bells. And I'm going to, get in, get out, and I go home at night, I sleep easy, no risk. Yeah, that was really great, but twice I watched this happen. The whole market made a shift, and it caught all of the successful traders in that office off guard. And the only ones that were left were those that could trade in the new environment. But when that environment shifted, a new shift to the guard, and the ones that had done really well before got stuck. So the problem with working just a single strategy is that you get very narrowly focused, and there come long stretches of time where the market conditions are no longer the same as what you had gotten used to. And so an inability to adapt, which usually comes when you focus, because you're paying yourself to not adapt and just get better and better. But when the market changes and takes away that opportunity, you really struggle. And that's why people have maybe a great career in trading for a while, and all of a sudden they blow out, and then they're like, okay, I got to do something else. But if instead they take this approach and say, okay, I'm always going to have 2 or 3 strategies at the ready, and I'm going to shift to the one that's paying me best, then trading can become a worthwhile lifestyle for you. So that's what the step-by-step method is all about. A step means you go get one, and then you go through the process again and get another, and then get another, and as many as you need to. As quick as you can go through the process, great. We are actually going to try to help you go through that process as fast as possible, so that within 6 months you can be fully set in whatever allocation model that works for you, the time you have, and your own personal ambitions for this. Because after all, imagine doing well at trading means you can never get laid off. You can never have to, ask anybody's permission to go on vacation. You can choose where you want to live. You can choose when you want to change any of those things, and your livelihood never has to change. So that's just a little bit about what the brass ring you're reaching for. It takes a while to get there. I'm not going to try to pretend like it's like tomorrow night, man, you're going to be no. But if you're serious, if you're here, if you found your way to us, you're probably serious about trying to make trading worthwhile for you. This is the framework on which we're going to try to accelerate that process for you. And so that's the beginning. Tomorrow, hopefully, we'll be able to be prepared to talk more specifically about the testing and trialing of systems and the standard for how you measure a system. In fact, we might even get into that a little bit today as Wes goes over his divergence discussion. But for now, that is what we're talking about with the seek. What are you trying to do with your strategies? What are you trying to find? Well, you're trying to find a group of strategies that works for you based on this allocation model. More concentrated, more aggressive, or more conservative, more diverse. And that's it.
Awesome. Okay. Yeah, now it's my turn. So hopefully everyone understood everything that we were just talking about. Well, I mean you. I don't know. I understood all of it, but that's just because I've been trying to say that type of stuff for years now, and that trying to stick with your one specific strategy on one specific asset class or financial instrument or whatever, there's something to be said for, I don't know, getting focused, but there's also something to be said for being too focused.
There's a risk. There's a risk associated with
exactly.
focusing, yeah.
No matter how well you trade one thing, there's going to be a time when you either aren't making as much money as you were before, or you are in fact losing money. And if you are well diversified, if you've got strategies lined up that are not correlated to provide you with income across multiple asset classes, multiple streams of income, then that can provide you with a little bit more security. And there's nothing 100% or guaranteed in trading, but you can manage your risk, and managing your risk by spreading it out a little bit is a lot better than putting all of your money in on the euro or putting all your money on Apple, except for the waiter guy.
Yeah, amazing. But see, then you gotta constantly be interacting with your mother a lot.
Yeah.
So, and maybe that's not a problem for most people. I tell you, for me, it would be a problem.
Yeah, for me, it would not be ideal. Let me tell you. But we won't go into family discussion stuff. That's a
the fact that we just
whole, yeah, that's a whole nother topic for never. Okay, let me go ahead and bring up the charts really quickly, and we're going to talk a little bit about an indicator that I built to help find divergence. But this webinar, or this broadcast, I'm so used to having webinars that live broadcast is like this new thing. But anyways, this live broadcast is not about getting this particular indicator. This particular indicator is to illustrate the process of building a system from the ground up and trying to build it in a way that you are accomplishing a specific goal. I built this indicator, and let me go ahead and switch over to it so you can see what I'm looking at here. There we go. Let me zoom in and make this line really big. That'll make this a little easier. There we go. Okay. So you see these two indicators here. This channel looking thing, I call the divergent channel, and divergent strength. This little strength indicator down here at the bottom. I built these two indicators just a couple of days ago. I just started on them, and I'm not trading based on these yet. But what I was looking for specifically was an indicator in a system that could help find divergence. And so the way that I think of divergence is when so the definition is basically when an indicator is disagreeing with price. So that's a very basic definition of divergence. But the reason why, that's what I have been looking into more lately, is the reason why the indicator would be disagreeing with price. So what disagreement am I actually looking for? And the best explanation that I could come up with, the best logical reason that I would want to see a disagreement between price and an indicator is that price is moving one direction for whatever reason, but the indicator is being the voice of reason. The indicator is saying, look, we aren't actually going to be moving in that direction much longer. We have some shifting tides here, or shifting sands, or whatever you want to call it, but this is no longer stable, and it's a way to determine when it's best to either start looking for a reversal of some kind, or when you should start planning your exit strategy for a specific direction in the market. So for the Australian dollar, Canadian dollar, I just picked one that I haven't actually traded on for a long time. That way I wouldn't have any emotional or directional bias for that particular currency pair. And the Australian dollar, Canadian dollar kind of stuck out to me. And so did the British pound US dollar, because I actually haven't traded on the British pound US dollar in quite a while. I give that one a wide berth, so to speak, for whatever reason. I think I got taken for a ride by the British pound US dollar a while back, and ever since it's been difficult to get back on that horse. So anyways, with the Australian dollar, Canadian dollar, so this is divergence. We see price is actually going lower. We've got a lower trough than we had just right over here. And this is a daily chart. So we're not looking for this to be spread out across a whole slew of candles. We don't need like 100 candles to show divergence in this on a daily chart. like we would with like a 15-minute or a 1-hour chart or whatever. Anyway, so we've got this low trough, and then we've got an even lower trough here, and yet price is actually moving upward. Or sorry, price is moving down, indicator is moving upward. So our indicator is moving up, price is moving down, and I built into the channel a price or a color change whenever the slope of the market has shifted. So when I was thinking about this divergence idea, and this is, we're getting to the indicator part of this now, when I was thinking about this idea of why is divergence effective? Why is it that I actually want to find something that's divergent? And why does divergence actually work? Why do people base anything on it ever? And so I started thinking, if it's shifting sands that we're looking at, shifting tides, then what we're trying to figure out is when is the market actually shifting? And to me, one of the best ways to do that is to look at the slope or the momentum of that move. So that's what I built this indicator to do. So that's what building an indicator with a goal in mind, that's what it's all about. So we're not going to be teaching, like, I'm not going to be showing you how to program an indicator, but it's actually relatively easy to try to figure out what pieces of the puzzle go together in the way that you're looking to. So I was looking for divergence, but there are some other types of systems that you might be looking to not automate, but build tools to help you find easier. That's what this is for, is to help find divergence easier, right? Well, we also want to be able to find stuff like support and resistance. We may want to find higher highs and lower lows without having to do an overall analysis of the chart. Now we can all see where the higher highs and the lower lows are on this chart, but let's say we wanted an indicator to actually give us some static prices. Well, one of the ways that we can do that is actually what Ainsley Clubb had been talking about throughout the past couple of weeks, and that's pivot points. And pivot points allow us to have a directional indication for the market, and also it tells us whether or not the market is trending, and it can tell us what some support and resistance levels are that we can depend on, and maybe not depend 100% on, but we can look at for a little bit of directional bias. But how was the pivot point and the support and resistance levels actually created? Well, it involves somebody having an idea about the market and then thinking it through logically and then putting it into an indicator. So that's building an indicator with a purpose in mind. Let me bring up the British pound US dollar really quickly. Maybe really quickly. There we go. British pound US dollar. Okay. So one of the cool things about divergence is the way that you can, I don't know, interpret it the way that you would like. I interpret it different than other people may interpret it, and then other people interpret it different than other people. Even Gordon and I have different opinions on what ends up being divergence occasionally, and he actually has insights into divergence as well, and he can interrupt me anytime he wants to. But when I was looking at the divergence that, I don't know, could or could not be on this chart, the British pound US dollar came down and it has more or less leveled out. It's creating this nice little rounded bottom right here, but it's not even close to finishing a complete rounded bottom type reversal. But what we're seeing from the indicator perspective is that even though the market has gone down and has leveled off here at this low, the indicator is actually moving way up. Now, we do see a lot of movement that goes up and down in the Forex market. That's not in debate here. However, what we're seeing is a very concerted movement by the indicator to go upward, and our slope has officially changed to an upward slope. This little green area right here, even though we've been going down for quite some time now, this little green area here shows that our slope has officially changed back to an up slope. Now, sometimes that happens even though we're going up or we're going down or whatever. We can see right here that the slope actually changed just briefly because we had a very large movement here combined with these candles that had gone down a little bit there. We had a very brief buy side slope reversal, and then we had another slope reversal, and then we went straight up. And that's great, but that's not that didn't involve divergence as well. That didn't have anything else to go with it. It's why we can't just rely on one specific thing. Not even divergence can be relied on 100% by itself, or even 50% by itself. Divergence has to be combined with other types of strategies. That's why I spent the last few days building an indicator or a set of indicators to show various things. So this is kind of the point here. Even though I saw divergence on the indicator between that and price, that doesn't necessarily mean that divergence is actually bringing the market back around. This disagreement may not actually last very long. If we end up going back and turning back down, then that's not a very significant surprise. I mean, you can't use divergence by itself. But we also have a slope moving upward, and we have a consolidating channel. So our little consolidating channel here is pretty cool. And we have a changing slope. So now, where is the actual entry? We can't just look around for something on a chart that shows one or two or three little things that we like. We have to have an entry point. One of the things that I learned from Gordon when we first met, I'm going to switch back to the camera actually. So one of the things I learned from Gordon when we first met was that the pieces, I know I keep switching.
No problem.
Without, the various pieces of what makes a system. And granted, I've created hundreds of systems, robotic and otherwise, like hundreds. And so I thought I knew, what made a system because I've made systems before. But what you told me when we first met was made it all a lot clearer. It was a lot more succinct, rather than saying, well, what you need for a system is you need an indicator and you need some price action and you need a specific instrument that you want to use and you need an account. And I kept thinking of all the big, massive, big picture stuff. But what it came down to was entry and exit and trade size, right? That's it. Entry, trade size, exit. So thinking of it that way simplifies your goal when you're creating a system and when you're creating a new indicator. So when I was building this particular indicator, this divergence indicator, that was what I had in mind. Was I wanted entries, I wanted to know how much I should actually leverage on this particular trade, and I wanted to know when I should get out of this trade. And so the indicator provides a filter, which is part of the entry. So now we have to figure out what the entry would actually be for these.
Yeah, is it all right if I jump in here, Wes?
Yeah, absolutely.
Okay, so one of the reasons I really like working with Wes is because he's smart and he thinks things through, like programming indicators. When he comes up with an indicator, it's typically going to be better than the average indicator, similar to what he's done, because he has that way of honing in on what's most important. Now, I have not asked Wes any questions. He's just showed me a couple of charts about this particular indication methodology, and so now I'm going to poke him for a couple of more, because already I can see on this chart that it has the makings of a good indication or a good foundation on which you could build a simple system. And I'll show you the kind of system I have in mind just by looking at this really quick, and we'll see how close it is to the system you had in mind as you're building this. Now, one of the things that happens with divergence is divergence is a great signal, but it usually looks a lot better than it really is, because you look back on charts and you see, wow, there's one. Once you train your eye to see divergences, you see them all over the place and they all look so successful. The problem is that the unsuccessful ones no longer look like divergence, right? There's this moment where the indicators in the chart are just both going down, and like, well, there's no divergence there. Yeah, but at this particular slice in time, if you'd have gone back there and you didn't know what was coming, it looks like the setup of a divergence. But because this one candle ends up closing all the way down, then the lines tilt and there's no more divergence. But for a brief moment in time, it was there. Well, all those are filtered out, and now what's left looks really great. Okay, now that's not saying that divergence is a bad system. Divergent indicators are a great system, but you have to make sure that you're programming something into your algorithms that filter out those false signals, or at least some of them. It's almost impossible to get rid of all of them, but you want to be able to filter out some of them. Well, Wes's algorithms and his approach to divergence tend to do a good job of doing that, of filtering them out. So when I see, this is a really interesting divergence signal right here. If I could see if I can grab, in fact, maybe if we could go with that shadow pointer here.
That'll work. Hold on, it has to turn itself back on.
Oh, okay. So there we are. All right.
There we
So the area I'm looking at right here is this portion of the price, or these three most recent 3 or 4 days, compared to where the line is. See how it's so much higher than down here. Now you could say, but that's just sideways. That doesn't mean anything. Actually it does, because look at the bottoms. They're slightly lower. They're still going slightly lower, not much, but slightly. Now they're rebounding back up. Very clear support sitting here in this area, but that indicator isn't bouncing around down here. It's coming way back up here, as evidenced by the fact that even on the down days, these prices still go up. See, that up action is what creates the math that this kind of an indicator will say, well, there's actually some bullish activity here. We need to be getting to somewhere, kind of in our middle range, and which is in here, and that creates this large separation, even though price lows are pretty close and getting a little bit lower. Okay, so now I want to focus on this area right here. So the shaded area. When you see these kinds of indicators that Wes built, I don't know what algorithms you use. There are a couple of different possibilities. One is something like a Bollinger Band, which is built on standard deviation statistics, or the other, my preference is a Keltner channel type, which is built on average true ranges. And Wes, is that too much a secret sauce to?
No, neither of those is even slightly correct. So
excellent, wonderful,
works out great.
So the thing is that when you have an indicator that makes these gaps, depending on how they're calculated. So Wes, you tell me if I'm off base here. I mean, just by the sharpness, it's not super smooth. I'm guessing that whatever you're doing, you're averaging periods less than, say, 6. There's 5 or less periods in here, maybe more like 2 or 3. But whatever's in here, this little extreme becomes interesting. Now, if this, for example, were a standard deviation, a Bollinger Band style system, then this extension would be, it happens because you have these 2 big days here, and they get sort of averaged into the price going forward. And so then a greater degree of potential move is forecast. And then you have this one here, which kind of snaps back in because of these 2 smaller ones, right? However, the fact that it went out there as an extreme, you can kind of think of it this way. Whenever you have indicators that show these ranges, you're sort of trying to mathematically calculate the possible behavior of participants, in this case in the pound dollar. What is the possibility of their behavior? How much selling or buying are they willing to do? Well, the math says that this mathematical model, which is what an indicator is, predicts that they might be willing to go this far with it. Okay, that's a great factoid to make use of in a system, because what that does is it tells us, kind of where our extreme of behavior checking ought to be. If we say, hey, prices could run all the way down to here, and if they went beyond that, that would represent a change of mind about something for a collection of traders or investors. And so then if we look here at the chart then at where we are compared to that that price level down here, 134, then this is great because it tells us we've got a lower limit that we can work with, and that can be our exception level, or in other words, our stop loss. So right here we've got this green saying this is the beginning of a potential new upward trend, because although we've been going down and down and down and up and not quite making it, we are holding so much support with these 2 days together. It's now indicating the position of a potential upward trend. That, combined with this very stark divergence, that's enough to pay attention and maybe make an entry on, right? So if we were to do a thing like that, we have to say, what is our risk? And the answer is that we want to have a defined amount of risk that we could factor in and say, at which point am I going to establish this trade is done? And then what is my opportunity, right? Well, you can see right here, well, you can see by going back on this, that these trends, these periods, they're not insignificant. They can really move on this currency for quite a while. So we're looking at a typical move of something like that, and that's great. That's wonderful because we're looking at about 2.5, 3 to 1 just to get started, and if it were a big long trend, it could be much more. Now, where then should I determine to get in? Well, now's not a bad time because all the indications are there. But here's the final thing I'll add to this. And sorry if I'm taking too much time here, Wes, but I'm very curious to get your reaction on this. If I see these as indications and say, okay, that's an entry point, potential entry point, and this is my stop point, know that I can make odds on what the chances of success are. And when I say chance of success, I mean turn around and going back up. Because we don't know, is this going to keep going back down? Well, if it goes down a little bit more, have the odds changed for my success? Yes. If you were to say, I'm going to get in here, and success is going to be that I'm going to go 2 pips higher, right? If that were my measure of success, then the chances of success at this point are very high, because it's only 2 pips. But the lower and lower I go, the lower and lower the odds of that success, 2 pips higher than my entry, are going to be. So as I go lower and lower, then my odds decrease for success. And if I go more than halfway to the stop loss from where I am right now, then my odds of success are lower than 50%. That's the way you can think of it. So where do I want to get into this trade? I don't want to get in anywhere less than 51%. I want the odds to be in my favor. So I can go in lower and lower and lower. Now you could say, well, yeah, but Gordon, if you just jump in, that doesn't mean it's going to go up. Like, right. I get that. But what's better? What gives me more chance of getting up to here? From this point or from that point? The answer is from this point, right? Now, my favorite way of getting in is set someplace higher than where I am right now. If it comes up, then get in. Yeah, I know it can turn around, but I find that actually gives me about a 5% statistical edge. If I just simply say, get in higher than where I am now, make the price prove that it is actually going up from here. It's amazing, but that actually is the case, that it improves your odds. And so if you like the idea of buying on a bargain, however, then you want to go lower, but you don't want to wait until right here. You get way down here next to the stop and you buy there. What are the odds that it's going to cross the stop compared to come all the way back up, right? The odds are really high. You're going to get stopped out just because of distance. Now, there are all sorts of other factors in the short term will change the odds one way or another. But these are your baseline odds. Just the distance of price. Is that price the same distance as another price that by compare 10 pips up, 10 pips down, they're equal? That's 50-50 odds. 20 pips up, 10 pips down, that's 30% chance that you're going to get to the 20 pips and 60% chance you're going to get to the 10 pips, right? It's that simple to think about the odds that way. And all you have to do then is say, where's my best entry point? Well, what odds do you want to play? What are the best? So for this system here, we have a nice divergence that might actually skew the odds in our favor. Where's the best place to get in? Well, it depends on whether you're like me, you like to prove the price going up, put it in 2 pips higher, or if you want a bargain shop, let it come back down a little because it could. And then you could actually say, where's the point at which that green will shift back to red? Probably the point where we make a new low. So if you wanted to go halfway between where it is now and where the new low is, that would be an optimal entry point because that would give you 50-50 odds of staying bullish with the cheapest possible price you could buy. So anyway, all of this looking over, I love the fact that this has this this has this extension down here because it's a natural. See, a lot of traders are going to want to put their stop loss a few pips below the low of whatever the price action is. That's usually a terrible place because so many stops are there. So many stops, especially when you get a sideways move right here, so many stops are there that computer algorithms and other traders, they're just waiting right there. But if in fact you don't have enough action, enough activity to want to go past this level here, right? In other words, that's all people are willing to sell down to. Great. Then yeah, it could happen, but it'll turn around and come back up. Now, if it doesn't, then you really want out because that's a new trend. That's a new mindset, a new set of behaviors. So when you have these sort of extensions like this, we'll see. Look at this one. Here's a great example. Suppose we got into this and all of a sudden it started coming down and say, okay, I'm going to try this because I think it's going to turn around and go back up. At what point would you want to be out? You'd really want to be out right there. Because look what it did afterwards. Kapow. It accelerated
that candle
fast.
closed at that point, at that level.
Yeah. I mean, it closed right on there. And if in fact it went any lower, then that shows deliberation of the trading mindset, the people behind this trade that are saying, no, we really want to sell more than we want to buy. So this is just yet another example of here is a great place not to be in the trade anymore. So you love those. No, you don't like losing money, but if you're going to lose money, you want to limit how much you're going to lose, and you look for signals that help you reasonably limit those, keep your odds in your favor, and so forth. So I like this divergence indicator already because not only does it have a good indicator, but it has a reasonable behavior-based price level at which you can set your stop. So what do you think my evaluation of this so far?
Well, I like it, and also the fact that if we take a look at the profit target that you chose, it's actually the top part of that same move.
Oh, it is interesting. Yeah.
Yeah. So it's actually the very top of that same move. So if it goes up to there, then not only do you have the top of the indicator move, but you also have this little area right here where we hesitated. The market hesitated during this particular candle, even though we were in a downward slump. The market hesitated right here at this exact level, and so even if we start going up again, there's a pretty good chance we're going to either hesitate getting up close to this level or even just stall out and then continue the move downward. The divergence indicator doesn't show a complete trend reversal for the market. It just shows opportunities to get in going against the prevailing movement. So the prevailing movement right now is downward. And right here where you had talked about this little spike downward, that was not even like that would be an indication, like, you were talking about putting your stop loss at that point. But the reason why we have systems, trading systems instead of gambling systems, is we have more proof or more evidence that we would be moving back around in order to actually place trade. This wouldn't have been a good setup because the indicator is actually still going down from the prevailing market movement. Like there would be no reason to take this trade at all because it wouldn't even look like a trade moving forward. And I think that's one of the the good things about having programmed so many divergence strategies in the past is I had to figure out how to make a computer understand when divergence was setting up. So in order to make a computer understand it, I had to also understand it from a basic, very basic written out way. So that's why looking for divergence setups is so easy for me because it's just...
we might consider that. If you've got your indicator down here not showing divergence and we've got the exceeding of a in this case trough, but we would probably also work on the upside in currencies. If you have the exceeding of a trading range, right, a predicted range, then that might be a good trending indicator. In other words, a momentum jump on kind of indicator. The difficulty is how far away you set the stop loss. But I mean, look at where that goes, right? Boom.
Yeah.
If we look back and see similar situations, I mean, you kind of got it right there in each one of these peaks, right? Each one of these peaks, especially the ones that are in a turn. So there's the peak, and once we get past that, We don't go much against it. If you want to go ahead and put that mouse right there where...
I'm trying. It's a touch screen, remember?
Oh, it is?
Yeah, it actually switched it back to looking at us there for a second.
Okay, sorry about that. So yeah, if you're right there, and you look at that and see where okay, yeah, of course, where the price exceeded this range, and it came back up here, hit above this, yeah, it retraced a bit, but not much. You could weather that, and meanwhile, kaboom!
Well, and I wouldn't even consider that a retracement. It's just a hesitation.
Yeah,
the market
well,
hesitated.
it does get down into here outside.
Yeah,
of the
but
range,
we're looking at bodies here. We're not looking at wicks.
Oh, okay.
Come on.
Well, if you don't use the stop loss, then you're right. You're not worried about that. but then on the way back down, you've got these items right here. This range is less interesting for a downward than that one. But look at where it does. It stops and then boom.
It's using the same levels over and over again. Look at that.
Isn't that interesting?
Oh, that is fantastic. Look at this. We've got this one here. We've got this one here. And then we've got, even this one could be kind of considered. Look how many times we jump back up to it.
Yeah.
And then we've got this one here. And then we've got this one here. Even this one could be considered that we went up as far as we could and then just hesitated back down. We had this one here, this one here, this one here, this one here. Oh, dude. That's a pretty popular level. Look, all the way back here, it hesitated in the middle of this massive, massive upward movement. And we've hesitated at this same spot right here.
So look at this peak right there.
Dude.
All right, so there's a range right there at, what is that, 137? Yeah, see that the peak of this one over here, whoops, sorry. I touched that. Do we take us back?
Nope, we're good.
Okay, great. Yeah, so right here, you see how this hits that peak, and when price, and it doesn't even hesitate here, we come crashing through this thing, and because we pass this, you're looking at this candle. It's like, when do I get in? How could I possibly get in here? It's just a runaway freight train. I jump on, I'm going to fall off. But this is your indicator. As soon as it passes that peak, you say, okay, I'm going to take a chance here because there's so much strength, there's such a change of mindset that the pullback is likely to be minimal. In this case, it was non-existent. There was no pullback. Just up it went for a huge upward run. They're not all going to be that way, but we actually have sort of a double peak right here. This peak matches that. I like these blue sky peaks. They're just out there. There's not price action pushing them or holding them up. It's like,
well,
what is that?
Look at the next one.
Up we go. This one up here, you mean?
Yeah, and then we blew straight through it again.
Yeah, exactly. And this one here, we have yet to get it, but I would bet that if we ever came back up, we would look at that and we would determine either there's going to be a hesitation. Well, no, we would expect there to be a hesitation. If there wasn't, then right at the top of that, that's where you would want to be in. Because especially with all these nearby resistances, because what this would be is a collection of stops. And once the price hits them and starts into those stops, it accelerates the move. That's what the dynamic is behind it. Anyway, lots of fun just evaluating your system.
Dude, we just built a trading system right here in the live broadcast. I was looking for divergence here, but this just became wow. This just became something different. That's pretty cool. So if we actually move down to this level, if we stop out, we could technically place a trade in the opposite direction, right?
Right. Yeah, exactly.
Yeah.
Exactly. Yeah.
Oh, dude, that is fantastic. Okay, so anyways, this indicator is going to be made available to Trader Continuum members. Everything that I build is going to be made available to Trader Continuum members. And so if we ever feature something on here that I built, unless I built it for some other company or whatever, then it's going to be made available to the Trader Continuum along with instructions on how to use it. You basically just got the instructions just now during this live webinar.
We'll tighten them up.
Yeah, we'll tighten that up a little bit. Okay, gosh, that ended up being a lot cooler than I expected. So we should end on that note, actually. I didn't really have anything else to talk about anyways. So tomorrow we will have more live broadcasts. We'll have all kinds of cool stuff coming up. Next week, we have Scott Cook, who's going to be joining us for the Trader Continuum live broadcast. He'll be showing us live trading with penny stocks, which is going to be fantastic. That guy is awesome, and he's like 8 feet tall. It's like he walked in, and I couldn't even put him in front of a green screen. He's just too tall. But he'll be joining us next week, And this coming Thursday, we'll be having a Trader Continuum member webinar with Giorgio Stoev, who will be teaching us about trading with E-mini S&P 500.
So is this the first webinar we're going to do where you actually sign up for that?
Yeah.
Oh, okay.
Yeah, this is going to be
We're going there,
very
folks.
first webinar.
Sorry about that. You're going to miss out on Giorgio if you're just here for the freebies. But but if you do sign up, you will be well rewarded, because Giorgio's not only interesting to watch and listen to. I'm telling you, I used to sit around 65 coaches, and he, more than anybody else, had unique insight that just nobody else. He had a way of looking at the markets that nobody else did, and it was right. So you don't want to miss this guy.
I can have all kinds of unique views about the market.
Right.
It doesn't make them even slightly right, or even right half the time.
Yeah.
But Giorgio is something special. Not only that, but when we were corresponding, one of the things that he said he enjoys, that he would like to do, is send out trade alerts, which no educator I've ever met likes sending out trade alerts. None of them. Do you know why that is? Because they suck at trading. So the trade alerts they send out are just terrible.
These guys aren't educators. These guys are traders.
Yeah, these guys are traders. Though,
you'll get annoyed every now and again when they're teaching, just like probably with us, because it's not refined teaching. Our whole idea here is we want to bring you people that know how to do it, not people that know how to say they know how to do it.
Yeah, not blind leading the blind type of a thing. We want you to follow somebody who's not going to walk you into a ditch or walk you into blowing up your account. We want you to be able to follow these people. But one of the other things that Giorgio said that he wants to be able to do, he wants to every week give at least one webinar, and he also wants to give market analysis. So we're looking at three things here. Nobody else has ever told me stuff like this. Everyone else that always talks to me or tells me what they would like to do or whatever, that's always minimalist. But this was, I don't know, this was something else. Giorgio is pretty awesome.
Yeah,
anyways,
you're gonna love it.
Oh yeah, well I'll stop on my little rant about Giorgio. But anyways, that's all for today. We will see you again tomorrow at the same time, and have a fantastic rest of your trading day. And I guess right now we'll fade to black.